Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 181st VideoCast, 171st podcast for the week ending April 6th, 2023. Happy Easter, happy Passover, etc. The girls had their Easter egg hunt over the past weekend on Palm Sunday. They had a blast. They're getting up there now, but still enjoying it. That was Mimi, and this is Annabelle, a little too cool for school on the picture front, but that was a lot of fun. Want to get right into the media real quick. We've got a ton of Ask Me Anything questions this week, so we're going to start out quickly this morning. I did a segment with Ann Berry over at public.com, which is an online brokerage like Robinhood. Thanks to Mike Teak for having me on. We're going to play this because I want to give you, in the next two clips, just my general overview on the market, inflation, earnings, etc., all in one place so I don't have to repeat it. So here we go.
Premium Hub. With that, let's bring in our guest, Thomas Hayes, Chairman and Managing Member of Great Hill Capital. Tom, welcome back to the show.
Thanks for having me, Ann.
Let's talk about futures right now, Tom. They're in the red as investors await new job data for the month of March. Walk us through why investor sentiment is negative as the report approaches, when we've actually seen a fairly robust bump up in stocks over the last 2 weeks or so as the SVB situation seems to have been resolved.
Yeah, it's a great question, Ann. I think we're in an information vacuum, waiting for these data points, waiting for the jobs report tomorrow, but most importantly, waiting for earnings. And earnings are expected to be weak, down 6.3% year on year. But the thing that's been surprising to me, Ann, is the fact that we haven't seen a lot of pre-announcements. You would think with earnings going to be so bad, you would see companies getting out ahead of it, which makes me believe that maybe the bar is so low they can step over it. As far as the data that you referenced, the ISM manufacturing earlier in the week was weak. The initial jobless claims coming in at 237,000, the continuing claims at 1.8. I think all of this is giving the Fed a little bit of cover to, maybe, their dot plot is at 5.1%, maybe pause, maybe go one more, but not a whole lot more than that. And I think the market is sniffing that out. You're seeing it in the 10-year yield. So we've got a lot of important information coming up in the next 2 weeks. And after a big run that you referenced, moving into the end of the quarter, I think we're doing a little bit of digestion here, Ann.
Let's unpack earnings a bit more, Tom. You just said that you were surprised that we haven't seen pre-warnings yet. That being said, we're only 6 days right after the end of Q1, so it would be a little early for companies even to get their internal flash results. So if we take a step back and look at it from a macro perspective, which sectors are you expecting to see perform how? If we can break it down, industrials, financials, tech, for example.
Yeah, I think what you're seeing here is the big tech free cash flow generators, and you referenced a couple of names. We own some Alphabet. It's good to see what's happening with also their chip announcement yesterday that their AI chip, the Tensor chip, is 1.7 times faster than the NVIDIA chip. So I think people have underestimated because they had such a faulty launch of Bard. It was kind of a debacle of sorts, but I think they're underestimating the amount of AI that they have to compete with ChatGPT and the hardware. You need the cloud. Obviously, they've got unlimited cloud, as does Microsoft. But now with the chips to be 1.7 times faster than NVIDIA, that's a major thing. So I think we're going to be.
That's a great point, Tom. Can you just to pause on that for a second? Because that is such a big story. And in terms of where Google is manufacturing those chips, so much conversation's been had about chip manufacturing overseas versus here in the US. Where is Google looking to make its super chip?
Well, I think that's good. It's developed internally. Where they source it to, I think will be spread out, and we'll know more over time as they continue to produce it at scale. But the key is the technology. It's no different than NVIDIA. They come up with the technology, they come up with the innovation, and then whoever produces it, whichever fab. But we're seeing more and more of the fabs start to come into the United States, as we know about Phoenix, as we know about Ohio, as we know about the CHIPS Act. So I think where it's ultimately produced in scale is going to be less important than the technology that comes out of both NVIDIA and out of Google that's going to drive growth and innovation moving forward. But getting back to the market a little bit about your point about bearishness, it was a good point that you made. The one thing that I've known, and I've been in markets for almost 2 decades, is that markets don't tend to top when people are overweight cash and bonds. And we're seeing that right now. You saw the Bank of America Fund Manager survey just about a week and a half ago. Investors more bearish than the great financial crisis lows, the European debt crisis lows, the pandemic lows. So with expectations so low going into earnings season, I think it's very positive. And usually this is the time, the first 2 weeks before banks start to report as early as late next week, is when you would see some of these companies start to pre-announce. So maybe they'll come out after the holiday, to your point. But I think it's a positive sign that we haven't seen at least a few come out this week, and we'll see. With expectations so low, that's a positive thing. But it's all ultimately going to come down to the Fed here. If we continue to get weak data, that's going to be constructive, before May 3rd, and tomorrow is a very important data point on that front.
We've also got March retail sales data releases coming out, Tom, next week. What's the weight that you would put on that report? What are you actually expecting to see from it?
Mixed signals and crosswinds, right? I mean, Walmart 5% up, constant currency, good. Costco today a little bit mixed, a little bit soft. So I think on balance, people are still spending, but they're being more selective. You're seeing still strong spending in travel. So we're gonna have to see. It's been strong. I think the Fed wants to see that a little bit weaker, to be candid, and maybe they'll get that next week, and that'll be another catalyst to say maybe the Fed has accomplished their mission, and they can start to ease off a little bit, and that would be constructive for markets. I think that the big thing here is this. The sooner that they pause, the longer they can hold rates elevated, and that's important for them to ensure that they accomplish their mission. If they continue to hike too aggressively, they're going to have to cut, and that's not a good thing for markets. What we've seen historically, if they just stop raising and don't have to pivot, which is a different story. But if they just stop raising, 6 months out, the market's up on average 13.2%. 12 months out, it's up on average 18.9%. And 24 months out, after they stop hiking, it's up 34.7%. So there could be some good things in the cards moving forward. We know that Q1 and Q2 economic results, earnings results are going to be really soft. That's why the market corrected 27% peak to trough last year, discounting those problems. But I do think as we get to the end of Q2 here, that the market's going to start to look to 2024, and maybe earnings aren't 248 that they're currently estimated at right now, but 240, 235, that's very promising, and the market will start to look forward to that. And I think that's why you did see some strength into the end of the quarter, a little bit of digestion now that we're waiting for new data, but overall constructive.
Let's just push a little bit, Tom, on this idea of the Fed starting to pause. I feel like the market just has not been listening, right? And we just saw yesterday Federal Reserve Bank of Cleveland President Loretta Mester explicitly said Fed officials will need to raise interest rates a bit higher and hold them there, quote, for some time. Yeah. She doesn't see inflation returning to the Fed's target until 2025. So, and she's now the third senior Fed chief over the last week or so that said this. So where on earth is the market getting this optimism that the Fed's going to stop? They're being pretty clear they're not going to.
Yeah, no, you make an important point, but I would say two things. Number one is Bullard and Mester, who have been the front-runner hawks in the FOMC. They're both non-voting members this year. So they play an important role to pin long-term inflation expectations, and they've been very, very successful in bringing down one-year inflation expectations and five-year inflation break-evens to levels in line with what the Fed is looking for in terms of their target. So what they say is valuable in terms of anchoring inflation expectations, but less valuable in terms of policy moving forward. The most important is what Powell is going to be doing moving forward. And he did reference disinflation, but he does really need the data cover. And now he's starting to get the data cover. So we'll see. Look, at the end of the day, what Mester said and what the market is saying is not that far apart. You're talking 25 basis points. And even what their dot plot is saying, you're talking 25 basis points. So I don't think that's a big deal one way or another. I think the market can probably digest that. And if they hold it there, then they can keep rates elevated which would be very, very constructive. If they go too far and have to pivot, that's going to be a problem.
Thomas Hayes, Chairman and Managing Member of Great Hill Capital. Thank you, as always, for joining us this morning.
Thanks. And we're back. And then earlier in the week, I did a segment with Phil Yin over at CGTN America. And this was more about the banks, about the bank deals, etc. And want to cover this one real quick because it has a kind of a different cut of ideas. So here we go.
For more on where the markets are heading, we're joined by Thomas Hayes, founder and chairman, managing member of Great Hill Capital. Good to see you again. You've been right about a lot of things, but one area that I think none of us have been right about is this inflation fight. It still remains stubbornly too high for most people, I would say. Some are arguing, why not just change the range to 2 or 3%? And that would give the Fed perhaps more leeway or flexibility. And then you saw the jobs numbers or the job openings earlier today that had dipped a little bit. And I'm wondering if we're trying too hard to find good news for the Fed when the reality is that the economy is strong, but somehow we want bad news.
Yeah, bad news is good news. That's the type of environment we're in, Phil. And we got some bad news this morning that the JOLTS report came in lower than expected. The ISM manufacturing PMI yesterday came in lower than expected. So it's giving the Fed cover to pause. And what we know from history is that 12 months out after a pause, on average, you're up 18.1%. So I think there's some positive things setting up for the economy moving forward. Earnings expectations are extremely low going into this earnings season for Q1, negative 6.3%. But you're not seeing a lot of pre-announcements, Phil. So it makes me think that low bar can be easily stepped over. And I think the last key point here to open up is, this chair, Powell, really looks to Volcker's playbook from 1980 to 1982. And the one part of Volcker's playbook that he hasn't yet followed is Volcker stopped hiking rates when inflation was still at 6%. And as we look forward in the next couple of months, as we start to see those year-on-year leases roll over, as we've talked about in previous sessions, I think you're going to see inflation drop, and it's going to give the Fed more than enough cover to pause here, just below 6%.
First of all, with all due respect, I don't think it's a good idea we bring in Volcker to this conversation because that just makes me more nervous. I actually spent the weekend and I rewatched one of my favorite movies, The Big Short. And I got to thinking, 3 weeks ago we had this earthquake, if you will, Silicon Valley Bank, and then we just talked about Credit Suisse. I mean, there's some big things happening in the financial markets that the past week, I feel like we've all just kind of brushed off and said, okay, it's fixed. Credit Suisse is fixed. Everything's one off. Is it really?
It's not going to be fixed until the government steps in and backstops the deposits, either a temporary backstop for 12 to 24 months until they get through Congress an increase in the insurance limits, the FDIC limits moving forward. Until then, you're going to continue to see this steady trickle of deposits out into money markets, into the bigger systemically important banks, the big 4 or 5 banks. And that's not a good thing for regional banks. And all you need to do every morning when you wake up, Phil, the key to the market is look at First Republic Bank, Pacific West Bank Corp, a couple of the other regionals. If they're red, it's going to be a red day for the market because the market knows the banking crisis isn't solved. If they're up, maybe there was some good news, a good headline overnight that makes people feel more confident. But this morning we got Hurricane Jamie back on the stage saying that this wasn't over, there were going to be repercussions, et cetera, et cetera. And I think the key here, it's one thing to say that, it's another thing to offer a solution. And everyone knows in markets, on the street, that the only thing that's going to put a clear end to this is not going to be the takeovers over the weekends. It's not going to be giving people back their deposits that went to your systemically important bank. It's going to be doing a backstop insurance so the deposit flight stops. These regional banks can't raise equity capital if they don't know what their deposit base is going to be in 4 weeks.
But fair enough. That might be the case for Silicon Valley Bank and some of the other regional banks here in the U.S., but that doesn't explain what happened to Credit Suisse, right? They had money, their business, they were in a restructuring program. There were comments made, I guess, in the days after that led to people being concerned that they would not get backstop. And then we had this weird run on the bank. And now seemingly UBS is getting a steal of a lifetime. Their main competitor essentially buying them for almost nothing. I mean, you have to think, does that mean there needs to be more consolidation in the banking industry? And then we heard about Deutsche Bank over in Europe too. And I think a lot of us here on the other side of the Atlantic or the pond, we don't really truly understand how the banking system works over in Europe. It's not the same as here.
Well, Credit Suisse was the most telegraphed 15-year slow-motion train wreck that you've ever seen in history. Anyone that was surprised by Credit Suisse's demise has been sleeping under a rock. Every single bad trade, every single crisis, every single controversy on Wall Street for the past decade, Credit Suisse has been front and center. It was a cultural problem. It was a leadership problem. UBS certainly got a steal, maybe for as low as 5 cents on the dollar with an unlimited government backstop. It's going to be highly accretive to UBS, and they're going to come out of this pro forma with $1.5 trillion of assets, a tremendous business, but they're going to have to cut at least 30% of the staff, if not more, to make sure that culture doesn't creep over to UBS.
So back to the rates and what Chairman Powell is saying. We are now, I think the last number I saw was there's still a significant portion of people who think there's going to be another 25 basis point rate increase. A number of other experts are calling for no hike at all. And I'll go back to what I said earlier. I feel like we are just now feeling the first impacts of the earlier rate hikes from roughly 12 months ago. What should the Fed do and what will they do?
What they should do is they should have stopped 50 basis points ago. What they will do is probably raise another 25 basis points because they haven't gotten the message from the banking system yet. But the market's already gaming this out. You're seeing the dollar weaken. You're seeing Treasury yields compress. And what that's telling us is the more they raise now, the more they're going to have to print later. As you look, gold is now approaching a 5,000-year high.
Did you say
high.
5,000-year high?
Yeah, if you look at the long-term charts, we like to look at long-term data. So the market's already sniffing this out. They can tighten and try to be Paul Volcker, but at the end of the day, it's going to cost them more in terms of the bailouts and in the case of breaking things like they've already started to see with the regional banks, with Credit Suisse, with other things. All these banks have unrealized losses. All these banks need to raise equity capital. And if you keep jamming up rates, number one, these people are going to have to pay more money to keep the deposits in the bank. And number two, they're going to take more unrealized losses on their portfolios and have to borrow from the discount window. It's bad policy. They just have to accept above trend inflation until those leases roll over.
Fantastic stuff. Always good to see you, my friend. Appreciate it there.
Thanks, Phil. I appreciate it.
And we're back. So I also want to thank Ellen Chang for including me in her article on thestreet.com. It was a headline grabber, why the recession is coming, but you'll see as a good balanced reporter, she took the other side of it with my quotes, which explains the reasons why we may avoid one. And then we have two quotes of the week. First one from Peter Lynch. Your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. And that is so true the last few weeks and even in the last 24 months. If you think about zero progress in 24 months on the S&P 500, and now it looks like we may be ready to finally break through and make some progress, and we'll cover that. And then the second quote of the week from Warren Buffett. I never buy anything unless I can fill out on a piece of paper my reasons. I may be wrong, but I would know the answer to that. I'm paying $32 billion today for the Coca-Cola company because ... If you can't answer that question, you shouldn't buy it. If you can answer that question, you do it a few times, you'll make a lot of money. And by the way, the corollary to that is when you're selling. I had a gentleman text me today who's been a longtime follower of the podcast and a very successful business person. And he said, do you think the market can go lower? And, I said, no idea, maybe a little lower before earnings. But again, what businesses do you own and how are they affected? Try to limit the day trading and start investing. Investing is a completely different skill set than building a successful business. And that's what very successful people sometimes struggle with, because success in business is created through action. Success in investing is created through inaction. And I think that's the quote, that's what Warren Buffett's trying to get at. And the other thing to ask yourself is, the corollary to this question would be, there's headlines, whatever, World War III or some crazy nonsense headlines that cause the market to go down one day, you say to yourself, I'm selling Coca-Cola at $32 billion today because, and it's worth a lot more than when he did this quote, obviously, but, and if you say I'm selling Coca-Cola at $32 billion because there's fears about Russia or China or Taiwan or some ridiculous thing, ask yourself, does that mean people are going to drink less cans of Coca-Cola? And if the answer is no, then ask yourself, what the hell are you doing? Okay? And that's what we try to communicate in this podcast, VideoCast, every single week, is to separate the facts and the data from the emotion and the noise. And the emotion and the noise robs people out of phenomenal futures. So you just have to stick through until the market realizes the inherent value when you're buying high-quality assets. So you can file this one under headlines you never see at market tops, and that is Bank of America says investors poured $508 billion into cash this quarter. I mean, this is the funniest thing in the world, because you have like pretty much every talking head still saying we're going back down to the October lows. The stock market crash hasn't begun because the recession hasn't begun, and we've covered that 100 times. Markets bottom 6 to 12 months before earnings bottom. So even if you think the economy is going to get a little worse in the next quarter, which is fine, then you'd be bullish on stocks, not bearish. It's just the other way around. The market's a discounting mechanism. But certainly, for all the Captain Obviouses out there, just keep in mind that you're crowded with all the retail people that you think that you're so much smarter than, all pounding into cash at the exact wrong time. So I think that, here's a sentiment from Jake Capel over at Sentiment Trader. And we cover this indicator every single week. Hasn't been this low since the S&L crisis in the early 90s. And that was the beginning of a 9-year bull run. Hasn't been that low since the 2009 lows in March of 2009. That was the beginning of a major bull run. And here we are, even lower than those levels. And I think we're going to be breaking out here and moving to the upside as we start to discount not what's happening in the next quarter, which could be worse, what's happening in 2024, 3-4 quarters out, and the recovery in earnings, et cetera, et cetera. Brief overview on the kind of general stuff. Again, tuning out the noise and just getting to the facts. You can see here the put-call ratio had a heart attack in December. It's been coming down. This is the 10-day, and that's exactly what it does at every major bottom. The huge heart attack, and then it works its way down, and the market works its way up. And keeps taking people out, because the whole way up, everyone keeps saying you're going to go back and test the lows, and you never do, and you push higher. It climbs the wall of worry and forces people in at the top. Other one, this is the 1% EMA of the advanced decline ratio. I think this thing is just perfect the way it's set up, exactly like 2011, 2012 lows, and exactly like 2015, 2016. A lot of fake out, a lot of chop, but eventually it worked higher, and I think we're exactly there. You get that first drop, you get this retest, and then you just chop your way higher, and a multi-year bull market, same exact thing. First low, chop, work your way higher, multi-year bull market, and I think we're set up for the exact same thing. And I know I'm in the minority. It's interesting, people are like, we basically had a constructive view since June of last year, and since October of last year is where we were pounding the hell out of the table. And that's basically been the exact right move, because if you look here, we'll get into it in the article, but basically the market's gone sideways. So if you were selling in the hole, you absolutely lost in both of those instances. And now since October, we've really ripped higher, and it's just getting started. So you just have to, look at the facts, and the easiest thing is not these indicators, is looking at the individual businesses. But this one I love, because we're going to talk a little bit about real estate today. This is the S&P real estate stocks above their 200-day exponential moving average. This is a beautiful signal. It comes at all the lows. It's down at the low levels, and that's when you get major recoveries, and that's why we've been looking, and that's why we were lucky in March to initiate on Vornado, which we're excited about, which you can't give it away. Like literally, you couldn't give this thing to your worst enemy with your mother's money. And that's the type of stuff we love. The only thing I'm missing, which I think it's probably out there, I just haven't come across it. I'm looking for the article saying that Vornado is uninvestable, because once we get that trigger, we know it's buy time. I'll just have to Google it, actually, because I haven't come across it in the publications that I read. Okay, same thing here. Bottom starting to work its way up. McClellan Summation Index. You can just see it. It's every single time the same exact thing over and over, and everyone's pulling their hair out. We're going to triple break putt, by the way. The first two breaks have been 100% wrong. It was supposed to be a rally into the end of the year. You got a crash. And then it was supposed to be a rally and then a crash into March. Exact opposite. We were up 7% year to date at the end of the quarter, the S&P, and there you go. So the third break doesn't even matter if the first two breaks are wrong. You're already in the sand trap and probably in the water hazard by now. Here's the Nasdaq McClellan Summation Index, same exact thing. This is what happens near bottoms. A little fake out off the bottom, retest, and then work your way up for multi-year rallies. And over. This is the NYSE version of the McClellan Summation. Then you have the skew is nowhere near levels that I would get concerned, where people are betting on 2 standard deviation events. We're nowhere near that. We're at the exact opposite. After the risk has come out of the market, down at the lows at the beginning of rallies, not at the end. And the VIX is working its way down, just like you see here in 11-12, and just slowly trends down while the market climbs the wall of worry. So same stuff, rinse, repeat. China's strong PMIs show economic recovery gaining traction. So they're just crushing it while everyone's remaining pessimistic. You see this is the highest even before pre-pandemic levels. With non-manufacturing, manufacturing is also back to above pandemic levels. Jack Ma engineered Alibaba's breakup from overseas, so he's got his hand in this. He wants to see value unlocked. He wants to be under the radar. Chinese leaders had him back, et cetera, et cetera. We covered this last week, so that's good. China's consumers extend economic rebound from pandemic. Note to self, just getting started. You can see it everywhere you look. Xi Jinping launches a charm offensive to repair China's tattered image. Look, opinion follows trend. He realized he overshot when he had the rioters in the streets. Now he's doing a complete about face. Meet the new boss, same as the old boss. China's services activity surges to more than 2-year high. Caxton Services PMI to 57.8. That's not just expansion, it's massive expansion. China's home buyers are starting to come back. Remember Evergrande, that was going to end the world last year. Well, what do you know? The game is back on. And in no small part to the stimulus that we talked about that started last March and didn't hit until they opened the locked apartments and let people out of their cages, which is just sad what they did. But they repented, and now things are flying. How to invest in China now. What I found interesting here was a quote from this First Eagle co-manager Christian Heck of First Eagle Overseas Fund. It's a high-quality value shop. He said, quote, Alibaba is very entrenched with over 50% market share in Chinese e-commerce. So when I say over and over that China is a toll taker and it's going to be a consumption-led recovery for the first time, government has focused their stimulus on consumption, not manufacturing and building ghost cities. 50% of every dollar or yen or renminbi is coming through Alibaba, more or less. And you could take the other side of that trade. Good luck. We're just going to climb that wall of worry up to the 160, 180 area that we talked about. They'll shake everyone out again before we make the final move. And in the meantime, we'll have a couple IPOs, a couple spins, and really unlock value. So it's pretty exciting. And a good friend of mine sent an article with someone did a sum of the parts of $170. I'm sorry, $160. And, I sent back like, hey, thanks for sending this to me. That's a pretty nice move. But it's tainted by recency bias because the author is extrapolating once in 100-year black swan earning growth rates and margin rates that are the aberration, not the norm. To get the proper valuation, you have to go back to normalized earnings growth, normalized cash flow margins, normalized, and I think not only normalized, but even above trend because you've got 2 years of pent-up demand 3 years that they've been locked up. So you're going to see not only increased earnings growth and cash flow growth, but you're going to see multiple expansion. And none of that was accounted in the model for 160, which is, a lot lower than what fair value will ultimately be over the next 12 to 36 months is our view. So that was that. Moving on. This is from BlackRock. Thanks to Meet for sending it over. They say, we prefer emerging market equities as China's restart may boost returns. You think? China's restart is set to provide a boost to emerging market earnings growth in our view, and we expect this momentum to continue. This contrasts our view that developing markets' earnings expectations are too rosy in light of slowing growth. So they show here the emerging markets activity, the PMI, versus the developed markets, and earnings estimates. They show developed markets flat, while emerging markets are just absolutely hockey sticking off of the Q4 lows, and that's going to continue, and we agree. U.S. dollar could weaken another 15% over 18 months as cooling inflation prompts the Fed to cut rates, research firm says. Couldn't agree more, and that's integral to our Alibaba emerging markets theme. Hedge fund billionaire Chase Coleman says buy big tech stocks. We couldn't agree more. We have Amazon and Alphabet, as we've covered. GM's first quarter sales up 18%. Ford's were also up double digits. Intel gets an upgrade from a longtime bear. We hate this call, but we think it's the right one. Opinion follows trend. After it's up 30% off of the lows, we've been talking about it for weeks. Now they're getting into it. Now they're forced into it, even though they hate it. Rolls-Royce, what do you know? CEO has a turnaround plan. The stock is up some 50-60% since we started talking about it. Intel scores an upgrade. Fundamentals may have bottomed. Analyst says, you think. This is all about peak inventories. This is all about PC. The pull forward is 3 years ago now. And the server, if you think, by the way, if you're bullish on AI, the way to play it is not through AI. The way to play it is through server chips, because the cloud business is going to go parabolic in terms of the amount of storage that they're going to need, which is going to help, by the way, not only Google and Amazon for their cloud services, obviously Microsoft, but also Alibaba, because they're trying to catch up as well. And that's pretty exciting. Big tech rally isn't likely to fizzle out anytime soon, LPL says. We agree. If you remember in Q4, we said you need to be in what everyone hates. And the things at the bottom of the list were communication services, tech, and now we like REITs that they've been completely flushed. It's time to move in. And not just any REITs. By the way, I'm dealing with REITs. I had a call with a friend who's a real estate expert this morning. Really valuable call. And he was basically talking about the replacement cost for these high quality towers to rebuild some of the assets the way that they're marked right now from scratch, with labor costs, material costs, zoning, regulations, etc. It would cost like 3 or 4x of what they're marked at book. And in the case of Vornado, these are the highest quality properties in the greatest city in the world, and they're trading at a 40% discount to book. So it's pretty interesting. So Google owner Alphabet says chips can beat NVIDIA's. By the way, their chips are 1.7 times faster than NVIDIA's chips. Okay, so everyone said that Google's behind Microsoft because their Bard launch was a disaster. And I've been saying they've got more AI. They forgot more about AI than Microsoft will ever know, and you're going to see them catch up and take over very, very quickly, and that's why we like that, and we like the valuation there, and that game's on. Here are car sales. You can see, thanks to Alan for sending this over, this is 2003 versus 2002, so big jump in March, big jump in February, big jump in January. And even starting to catch up in February to the pull forward from 2021, when there were chips, when there was supply, when there was free money and all that stuff. So, my good friend said to me today, he was buying a new car for yesterday, he was buying a new car for his wife. He's like, I can't believe I'm watching this play out exactly as you said. I was like, what are you talking about? He's like, well, if you lease it, it's too expensive because interest rates are high. If you buy a used car, it's too expensive because financing is too expensive. The only way to get a deal is to buy a new car, because we went to this dealer and the financing was, I said, what was it, 2.99? He's like, no, it was 3.2. I'm like, well, there you go. In a 7% interest rate environment, you get 3.2. There's nothing to think about. He's like, there's absolutely nothing to think about. And he got a little potential discount to sticker as well, because you're getting supply back online. And that's just going to accelerate. And you got to consider the average car is 13.1 years on the road. Maybe now it's 13.5 since we started the thesis in May. So this is exciting times, and this is going to continue. And don't get distracted by the noise. Want to play this short clip from Bill Rudin, who's one of the greatest New York real estate families in the history of the New York City. And Andrew Sorkin asked him this morning on Squawk Box, would you buy regional banks? He said, I wouldn't buy regional banks, but I would buy a REIT that's been down 50, 60, 70%. And guess which one you think he would be buying, by the way. So take a listen here.
Would you buy stock in a regional bank right now?
I probably would not buy stock in a regional bank. Would I buy stock in a REIT that's been hit down 50, 60, 70%? Maybe. I have enough real estate, so I'm not the right person.
I'll make it more complicated.
And we're back. All right, moving on to the article of the week, stuck in the middle with you, stock market and sentiment results. You see this first chart. It's at the same level. This is the S&P 500 1 year ago as it is 2 years ago. So in 24 months, absolutely no progress, no gains for the S&P. As the old saying goes, markets can correct in price or in time. In this case, it's working off the post-COVID rally from 2020 over the last 2 years while earnings catch up. And earnings are actually continuing to press forward. Even the pessimists this year at 221, next year at 248. They're climbing higher and higher, and that's up quite a bit from the pandemic lows of 140 and the pre-pandemic at 162. So we think there's runway, and we think actually, as we said with the public interview this morning, it's surprising that there aren't more pre-announcements this early, because banks are going to start reporting next week, and that tells me that the bar is set so low at negative 6.3% that they can step over it, and we're going to get some positive upside surprise. And even Bullard, Mr. Pessimist himself, said that the Q1 data came in much better than expected. So during this 2-year slog of hurry up and wait, Steelers Wheel lyrics describe the landscape perfectly. This is from the song Stuck in the Middle with You. Clowns to the left of me, jokers to the right. Here I am, stuck in the middle with you. So from the Cassandras, the clowns who have continuously warned that the sky is falling, to the Pollyannas, the jokers who insisted every day should be an up day, at the end of the day, absolutely nothing happened. A lot of noise and zero movement. The good news is, I should have taken a 2-year golf vacation. The good news is resolution is near. According to Jonathan Levin at Bloomberg, a range-bound market, of course, simply conveys that investors are collectively trying to make up their minds. Sideways trading can presage big turning points at the end of years-long bull or bear markets, but it can also mark periods when the prevailing trend takes a breather only to get right back on track. Throughout the recent history, long-term sideways patterns exhibit more upside breakouts than crashes, but that's to be expected because stocks rise on average more than they fall, a lot more, over 70% of the time. That's my editorial, by the way, based on facts. Notably, these narrow ranges rarely last more than 250 trading days or so, and the current market is about 233 days old. In the mid-90s, the upside breakout came around 300, day 300. In the financial crisis, the impasse ended around day 340. But I'm with the jokers here, that's the Cassandras, and think this resolves higher. While the Cassandras, the clowns, always sound more sophisticated, the Pollyannas, the jokers, wind up with all the money over time as the market trends higher 70% of the time. If the roulette wheel had 70% black and 30% red-colored pockets on the wheel, and there was no penalty for sitting there all night, which there's not when you hold high-quality businesses, where would you place your bets? On Tuesday evening, I joined Phil Yin. Okay, so we went through that. As you can see in the notes below, what I plan to cover and what we actually covered are two different things. So here's what I plan to cover. We've gone through the positioning already. Markets don't top when everyone's overweight cash. Fed's nearing the end of its rate tightening cycle if they haven't already. So where do you want to benefit? And one area besides healthcare and biotech, which we covered last week, I want to talk about is REITs and Vornado. This is a very unconventional call. It's certainly not without risk, and its position size is according to that. But I think this can be a double plus. And why do I think that? Number one is they've already cut the dividend 43%. Down to $1.50, but because the price is so low, it's still yielding 10%. So while there's room to cut if needed, which is comforting, I'm going to not only get the benefit of having a locked-in 10% yield, but when times improve 24 to 36 months out, they're going to normalize that that dividend back up to pre-pandemic levels, maybe 2026, 2027, and I'll wind up with a 20% yield on invested capital every single year in perpetuity, plus probably 150 to 200% appreciation over time. And you don't need to look much further. Yes, you have $1.8 trillion of maturities and all that stuff coming due. There's going to be another extend and pretend. And if you go back to the full Bill Rudin interview, and you can Google it under Squawk Box Bill Rudin, he said there'll be another extend and pretend. And there's no question that they'll do some deviation of that. Why? Because the banks don't want to take back the properties. Why would they want to take back the properties in a market they can't sell when they could just extend it at favorable terms, keep them marked to make believe on their books, let the thing resolve itself, and everyone gets back to normal. And I think, like the S&L crisis, all these things they've learned from history. They just have to work through these situations that way. Because if they act like ideologues and, there's no flexibility and everything else, it just flushes everything and it costs them more at the end of the day. So it is what it is. That's the way it's going to work, and so on. So now what's important about Vornado is that if you look relative to pre-pandemic levels, 2019 levels, as of the end of 2022, the last reporting period, which they just reported in February, excuse me, the rental revenues are down just 4.9%. The book value per share is down 16.45%. The funds from operations per share is down 9.74%. And the occupancy rate in their New York City properties, which is the bulk of their portfolio, are down to 90.4% from 91.3%, or 0.9%. So again, rent down 4.9%, book value 16%, funds from operations 9.74%, occupancy rate less than 1%. And what's the stock price? It's down 75%. Okay, 75%. Now, these divergences between price and fundamentals is where big gains are made over time. As Ben Graham said, Mr. Market is a manic depressive. Take advantage of the emotions versus being at the effect. They already cut the dividend in January, 43% from 29 levels, yield still above 10%, plenty of room to cut. It's trading at a 40% discount to book. Now, you can say book is wrong, and I wouldn't disagree. I mean, talking with experts in the industry, they would say, because of rates, number one, and because of occupancy uncertainty, all of these should have a 40 haircut. Well, the market's already priced that in fully, and that's the beauty of public markets versus private markets. I'm not buying Vornado because I think the pain is over in the private markets. I'm buying Vornado because it's a public equity, which tend to bottom before the maximum amount of pain is in the private markets. I wouldn't do a private deal today. I would do a public deal. And just like I was buying the S&P and we were pounding the table on stocks last October, it's not because we didn't think the economy wasn't going to get worse. It was because we knew in public markets the market bottomed 6 to 12 months before earnings bottom. And I think the same case is true in the case of Vornado. And just to take a look, ladies and gentlemen, take a look at this. This is Vornado trading down to It's trading at the great financial crisis low levels when basically banks were going out of business, credit was freezing, unemployment was spiking, the world was ending, everything was off a cliff. If they didn't take Steve Roth out on a stretcher during the great financial crisis, it ain't going to happen now. That I can assure you. It'll be bumpy. It'll be fits and starts, but this is going to revert back. And by the way, if you look at the 10-year yield today at 3.28, you're going to see refinancing rates come down. That's number one. Number two, which is a very important point that no one's thinking about. This whole nonsense about work from home is changing the world forever. I think this is a fallacy that is based on a tightening market. And anecdotally, I was talking to someone who cut, a friend of mine was talking to someone who cut 20% of their staff. And he said, look, I would never say this publicly, but the 20% I cut were the 20% that are working from home. And it was an easy decision. And I think you're going to see more and more of that. And as the unemployment rate goes up from the lagged effect of the tightening, as we see in the data this week, by the way, you can see here the continuing claims were at 1.8 versus 1.69 expectations, 1.82 versus 1.69. And the jobless claims were over 200,000 again. Initial jobless claims were 228,000. So we're probably going to see that actually reflected in tomorrow's jobs report. The more unemployment ticks up, the more nervous people are going to get about their jobs, the more they're going to race into the office and want FaceTime with their boss to protect their job. And this whole thing is of I only work from home. It's game over. Once there's a supply of labor and the employers are back in control, everyone's going to be back in the offices whether they want to or not. And the smart employers are already doing. That's not to say it won't be 3 days a week or 4 days a week, but whether you're coming in 1 day a week or 5 days a week, you still have a desk, which means you still need the square footage. And in the case of Vornado, which has the best properties in the best city in the world, I think it's just like what we just saw in banking. The big get bigger, like the systemically important banks are going to be the beneficiaries of wrong-minded policy from not backstopping the deposits. The deposits are going to continue to flow into the big systemically important banks until there's an explicit guarantee. Then the pain will stop for the regionals. The same is going to be true for commercial real estate, just like you saw in the malls. A few years ago, everyone was saying the malls are going to blow up. Well, the B and C properties blew up for sure, but the A properties got stronger. Simon is doing just fine, and weathered through basically a retail Armageddon with the pandemic, and they're still fine. And the same is going to happen with the prime properties, and that's what Vornado is. Vornado is Park Avenue, Madison Avenue, 5th Avenue, 6th Avenue, a little bit of 7th Avenue, some Central Park South, Times Square, Penn Station, Lexington. Simply put, the best properties in the best city in the world. If you think demand is dead for that, there's a whole lot more to worry about than Steve Roth. I can tell you that right now. So that's basically the story there. Let's see here. Okay, so we covered biotech last week. Another uninvestable stock, 3M, that we covered in recent weeks. Over the weekend, Bloomberg quoted an analyst from RBC who called 3M, quote, uninvestable. And this is a company we have started speaking about in the last couple of weeks. They have compounded capital above 20% a year for over a decade. It is down on the basis of litigation risk for PFAS, which is the forever chemicals, which is basically the stuff you spray out of fire extinguishers. The way I look at it, I'd rather put out the fire and have a little PFAS in my bloodstream than burn my whole house down. But I'll leave that to the environmentalists to debate. They've got the PFAS forever chemicals litigation, and they've got the combat earplugs, which basically people are claiming that they wore them during their service, and they had the earplugs weren't strong enough. They should have been stronger. So reasonable analysts reserve $18 billion for over many years for the total expenditure. Here's from analyst over at Morningstar. We believe that a liability of nearly $4 billion is roughly fair for combat arms based on comparable fact patterns. on a per plaintiff basis adjusted for inflation. Our number is somewhat higher than the $1 billion 3M initially committed to fund with its settlement trust. We don't believe 3M will be successful in appealing its latest unfavorable bankruptcy ruling. We also earmark about $14 billion in legal liabilities related to PFAS based on comparable environmental and product liability cases. I think that's very reasonable, and I think that's a drop in the bucket for 3M. And if those turned out to be true, the stock would be at new highs within 12 months, which means a double from here plus. And you could just take a look at the long-term business here. MMM. Okay, so it's down from 216 when this nonsense began. And you can just see this is just a long-term compounder. Any chance you've had to get it to buy it at 50% off, you've always doubled your money within a few years. I believe this time is going to be no different, or in many cases sooner than a couple of years. So, and what kind of triggered it was, J&J settled this talc powder thing a day ago. Let me get to that in a second. So this analyst has it at $18 billion. The U.S. Department of Defense records more than 175,000 plaintiffs in the combat arms earplug lawsuits, showed that most of them had normal hearing. So basically, you have these 175,000 people suing at MMM, and the 3M gets the hearing records in discovery and finds that pretty much all of them have normal hearing. And what'll be really interesting is what percentage have normal hearing relative to a random sampling of the general population. So let's say out of 175,000 people, 10% don't have good hearing. Well, what is it for the general population? Is it 12%? Is it 8%? It might be even less than the general population, but I'll let that worked out by the legal experts. The point that I'm trying to make is it's crazy because you have some ridiculous analyst seeing the liability as much as $100 billion, and that's why the stock is trading down. It's silly season. The Australian government maintains that there's limited to no evidence that exposure to PFAS significantly harms human health. And I think for some of the things now, 3M is winding down its PFAS business by 2025 because they just don't want to deal with the headaches. If they thought it was dangerous, they would wind it down yesterday. But they're kind of striking a balance here, and it is what it is. But considering what we saw with J&J settling their talc powder lawsuit for around $8.9 billion, despite claims that it directly caused cancer, by the way, it was pretty understood, and they were able to sell for 8.9. This 14 billion may be way too much, and I want to put that in perspective in just a second. So I would take the under on total exposure. Now let's just assume that we're wrong and it's double what would be realistic, and it comes out at $30 billion paid over 10 to 30 years. It would not materially impair the intrinsic value of the business at these levels. They could simply cut the dividend, which costs, by the way, $3.3 billion a year. They could cut that and pay out the liability over 1 to 3 decades while continuing to compound capital, the intrinsic value of the business, above 20% a year moving forward. It's just unbelievable. Rarely do you ever get the chance to buy a compounder like this. Look at this return on capital: 27%, 28%, 26%, 27, 35, 30, 32, 28, 31, 19, 21, 23. Okay? Gross margins have stayed the same for all these years in the high 40s. So return on equity is even higher, obviously. So you just don't find businesses like these marked down 100%. Now you could say, well, that's because this crazy lady or person at $100 billion is right. Well, you can take that. But at the end of the day, you got to take a risk. And the thing that I've learned about these companies over time, when they have reserves, they'll just keep appealing it. They'll just keep tying it up in court. And sooner or later, the plaintiff's attorneys want to get paid, and they just take a reasonable deal. And the plaintiffs get way more money than they could have ever imagined in a lifetime, and the company gets out of it for half what the worst case scenario ever was. And that's just the way it works. So this time will probably be no different. And always remember, Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. So look, that's from Warren Buffett. All you need to know is this business knows how to compound capital at rates well above its cost of capital, well above market returns, and well above most money managers. So there's nothing to think about in terms of the intrinsic value of the business and management. The only question moving forward is there going to be a dividend or not? Do you need that 3% dividend or whatever it is now, 5%? But it cost the company $3.5 billion. So that's either going to go to the plaintiffs or it's going to go to you. But irrespective, they're going to grow the business at double digits every single year, whether you get a dividend or not. And that's just contingent upon the liability. People look at these figures and they think, wait, the business is worth whatever, 80 billion, and they're going to have to give 40 billion away. They're going to go bankrupt. That's not the way it works. And the market's going to quickly realize that, and you're going to make it, well, I don't know what you're going to do. This is what we're doing. This is opinion, not advice. See terms at the top of hedgefundtips.com. You know, nothing's guaranteed in life, but you have a basket of these uncorrelated risks. You do well over time, and that's what we're doing. So we tried to pick the ugliest stocks that no one ever wanted to touch for this week's article of the week. I hope you enjoyed. If you didn't have a basket next to your desk, maybe grab one, but I think that you'll be pleased when we look 12 to 24 months out. Here's the AAII sentiment starting to move up to neutral, 33% bullish, up from 22. Opinion follows trend. Fear and greed was at 53, which is neutral, and the National Association of Active Investment Managers are starting to get exposure. Some unusual activity. We saw a ton of unusual activity in Alibaba this week. Someone bought 12,337 contracts on September 2023, 170 call options for Alibaba. I think this is a dumb bet, but I think it could actually work for them. It's like very, very far out of the money, but it wouldn't shock me. I mean, so they paid about $1. So they paid about $1.2 million for this bet. That'll give them the right to control, a ton of stock. Okay. That'll be about $200 million worth of stock at $170. And it just shows, though, this is not grandma next door or some retail trader putting on a couple trades. This is an institution taking a real bet, and they think there's major upside catalyst here within a few months, which is amazing. I like to go much further out, but it's good to see that. Same thing on Amazon. Here's an institution that did 2 trades, 4,000 contracts of Amazon out in June 2025 at 170 strike, which we own Amazon. Same thing, another tranche of 4,100 contracts also out for June for 125. So they took a super punt at 170 and a pretty solid thing at 125. Earnings for the week, oil and gas top 30 weights. Their cumulative earnings power dropped by 45 basis points for 2023. It rose by 0.5% for 2024. So that's the top 30 weights of the oil and gas E&P services, rather. So they're basically flat, even though the stocks have kind of run. Now, this is the interesting thing of the week, in my view. The ARK fund, the Cathie Wood fund, the top 30 weights of her fund, if you look at estimates, in the last 60 days for 2023, the earnings power of these stocks has gone up by 10.86%. Who's talking about earnings going up by 10.86%? And for 2024, the cumulative earnings power of these top 30 weights in her fund, the earnings power estimates are up 12.97%. The tide is changing, ladies and gentlemen, so pay attention. This is why we dig under the surface and we ignore the noise and do the work. And these are the nuggets that we find, which are very, very important. All right, some of the economic data we went through: the jobs weak, the ISM manufacturing weak. So all of this stuff is giving cover for the Fed to stop, or if they're desperate, they'll go up to their dot plot 5.1, which is another 25 basis points, which makes no sense, but they'll probably do it anyway. But let's get to the articles of the week. The Ask Me Anything questions of the week. We got quite a few, so I want to get right to it. Ite Naman. Hi, Tom. Wondering if you could take a look at Delta Apparel, ticker DLA. It's profitable growing business trading below tangible book, excluding operating leases from assets and debt. Got hurt by extremely high cotton prices, inflation, low demand. Management projects margin slowly returning. 3 segments. CapEx. Management has a lot of experience and insiders are buying. Not confident about the moat. Seems cheap nonetheless. Anyway, the podcast is invaluable learning for me. I'm excited every weekend and shared it with my friends and colleagues. Thanks, Ite, and thank you very much. By the way, if you guys are finding value in these podcasts and VideoCasts, the best compliment you could pay me is to share it with one of your friends. Say, hey, I know you love markets like me. I found this helpful. You may find it as helpful as I do. Take a listen, and that's how it grows, and that's how we keep doing these. So thanks for doing that, Ite. So let's take a look at this thing. I've never heard of it. DLA, Delta Apparel. Huh. Okay. Delta Apparel. Let's have a look-see-loo. All right. So, revenues, it's a smaller business. They're choppy, negative free cash flow. It's a short-term negative free cash flow story according to management. Let's take a look. Lifestyle apparel, DTG, keeps athletes dry, Delta Dry Rine, ring spun garments, soft apparel. All right, I'm not familiar with Salt Life Langer Band. Delta Apparel Inc. Let's just see here. Salt Life Lager brand. It's in Duluth, Georgia. So I'm not familiar with any of their products, but that doesn't mean anything. All right, so let's see what revenues have been doing. Basically been flat for 8 years. Margins have been basically flat. Okay, about 20% gross margins. Not a great business, but it is what it is. Earning $1.79, trading at $10. Balance sheet. Wow, they're very low on cash, if that's accurate. Got $600,000 of cash. That's a problem, my friend. If that's true, $57 million of receivables. $148 million of debt. That's why it's trading down to where it is. Book value per share. You got to figure out how much of that is intangible from acquisitions, but yeah, it's trading at a discount to book. But the building value is only $4 million. This is looking too hairy for me. Let's see here. Cash flow. It's a low quality business, but so they just went negative cash from operations for the first time this year. still doing pretty big CapEx. Free cash flow negative. Yeah, I mean, the big question for management is, how do you stay in business? Are they doing any sale leasebacks? Are they, how are they going to raise cash? Because they've got a few $100,000 of cash, and they've got $7 million of interest expense. This is not looking great. So you just have to know, how are they going to stay afloat? I mean, is really what it comes down to. I mean, just looking at it objectively, it's probably a trade. They'll probably scramble and figure it out. I mean, you got to size this thing small. You got to understand the brands. What is this here? I do think that apparel is coming back, and we have a clothing brands company in the portfolio, which I don't think we've talked about yet, and we're not going to. But brands. I mean, the brand's been around since 1903. I don't know. You have to understand. Ask your teenager if these brands matter to start. But figure out how they're going to stay in business. How are they going to pay that interest when they have no cash? Where's the cash coming from? That's the name of the game with 90% of it. So I'm a pass on that. But, I mean, there's probably an answer to that question, in which case, you could get a recovery, and as they did during the Great Financial Crisis. But I'm a little worried about those cash balances. So let me just see something here. If I can quickly see if that's correct. I mean, $300,000 is like, what are they doing? All right, while I'm doing that, let's go to the next question from Mohammed Al-Otaibi. Hi, Tom. Always looking forward to your podcast. Got a question. I love to buy nets that are quite illiquid. How can I pull off the buying the stock without the stock jumping 8 to 10%? Seems impossible using limit orders. How do you pull off block buys on small companies? Does it take months to build a position? We don't do a lot of small companies, and usually if we're buying a small company, it has such a large margin of safety that it's got to be a 5 to 10 bagger, and we don't care if the stock moves 10% if we're looking for 500% plus. But yeah, we'll build it up over time anyway. All right. Just bought American Outdoor Brands. This is following the coming consumer discretionary wave. Company balance sheet solid. Company should be trading at $15.18 per share, considering $18 of operating cash flow. If we take into account 30% growth rate, that puts the company valuation around $300 to $400 million. 3 to 4 bagger easy from here. Company issued $10 million buyback program, just 10% of the float. $2 million already run up. Why now? Peter Lynch stated, if a company has been depressed and the inventories are beginning to be depleted, it's the first evidence that things have turned around, which is, by the way, our semiconductor thesis. We can see inventory levels peaked August 2022. This is where the stock bottomed, and we should expect improvement moving forward. Already have a big position. Much appreciated. Well, I don't think you're asking for my question then if you already have the answer, but I'll take a quick look at it here. By the way, this is... Yeah, so DLA is expected to really recover according to consensus guidance. Let me just see the cash is what I'm really interested in. All right. Yeah, 327,000, and here is showing 236 million of debt. So we got to figure out, where's the cash coming from. I mean, this is the issue, because if they have something like a sale leaseback, or they're going to get $10-15 million of cash on the balance sheet quickly, which maybe was covered in the conference call, then I think it will recover. But otherwise, they're BK. I mean, this is a problem. All right, so let's go over to AOUT. AOUT. Yeah, this has not been public for a long time. So for me, that's usually a red flag. I like to see how they can operate through multi-cycles, but which is one of the tenets in Ben Graham's security analysis and intelligent investor. So here we are. Let's pull up the stock here. Where's the... So the revenues have been growing. Well, they collapsed from 2021. You had a pull forward to, so it went from 167 million to 276. Now it's back to 194. Operating expense. The company's losing money. So generating nice cash from operations. They did an acquisition with some of that cash. Let's see here. Change in cash, free cash flow yield. So they are generating cash. CAOUT. You know, just because a group may recover does not mean a company will recover. Like Gap has never recovered. I don't love this one. I appreciate the enthusiasm. I mean, you've retained the margins. I'd have to study more, but chances are, if I was just doing a quick screen, I would pass on this. I'd have to understand the brands. I'd have to listen to management. But just what I'm seeing in the financials, I'm not excited. I don't care how cheap it gets. It's a pass for me. But that doesn't mean it won't work, and might be phenomenal for you. Tom Corbett. Hey, Tom. Hope all is well. Wonder if you have any recommendations of learning resources such as books, etc. Yeah, I've gone through these quite a bit in the past. Number one is Ben Graham Security Analysis, followed by Ben Graham Intelligent Investor. Number two, if you don't know anything, read the CFA books and get started there. Number three, read every annual letter that Warren Buffett has ever published. You can find it at berkshirehathaway.com, and then you can get the ones from when he had his partnership. Just Google them online. You'll find them. And that's your starting point. And then, as I always suggest, read 5 value line sheets a day. Over a year, you'll learn 2,000 companies, and then you'll have some basis, and then you start to learn more as you get experience. Kayla Smith, love the weekly videos. What are your thoughts on Sabre Corporation? Sabre, S-A-B-R-E. It's a travel-related software for airlines. Travel has quickly returned, but is there any hope for Sabre at these levels? Let's take a look. Negative cash flow for the last 3 years. Revenues are down. I don't like this. I mean, Yeah, the issue here might not be the travel recovery. The issue might be that it's losing share and has a crappy business. But let's see which one it might be. Yeah, so something, after the pandemic, revenues cut by more than half, like 70%, from 3.9 down to 1.3. That's bad. They've recovered. They're back up to 2.5, so it may be, in fact, COVID related. And as the China travel comes online, let me see how much business they do, because internationally, let's see, car rental, carriers, cruise lines, hospitality solutions, South Lake, Texas. I can't see from here how much they do internationally, but that would be an important tailwind. So they've been losing money since the pandemic. I mean, that makes sense, obviously. Let's see if they've got enough cash to weather through another couple years. Yeah, that seems okay. Current liabilities are reasonable. Man, they're burning cash, though. Oh my goodness, yeah, you're threading a needle here, hoping that they're going to get a full recovery before the cash runs out. This is... Just see something here. Yeah, it was a decent business. This is not a slam dunk, but I mean, I'd have to listen to 2 years of calls and look at some of the investor decks and have confidence that it's purely volume related, not share related. If they're losing share to competitors or their technology is outdated, then they're toast. But if it's exclusively based on volumes and their decline and recovery is commensurate with volumes, percentage to percentage, then I'd say you might have a leverage rebound here, and this thing could be a multi-bagger. But that takes a lot of work. But that'll lead you in the right direction. At least listen to 8 calls first. See how management's story has changed over the last couple of years. What they were saying was going to happen, why it didn't happen yet, and what's going to happen moving forward, and that they have enough cash to make it through if you believe the story. But I think with something like this, you really have to size it small, because if it's going to be a 5 or 5+ bagger from these levels, it could also be a 0. And but the key question you've got to answer through your research is it, have they lost share, or have they has their business decline commensurate with overall volumes, and meaning it will recover commensurate, and then you've got the operating leverage moving forward. And it may be worth a further look. I think that's kind of interesting. Jason Patel, hi Tom, could you cover Schwab again in your Q&A? You briefly covered it a few weeks back. It was a bit expensive, but the price is retraced. Curious to get your thoughts as it approaches $50. I have no real change. I think until the government steps in and backstops deposits, I don't know. Yeah, this one's tough. It's a good business. I mean, for me, it's Bank of America is more of a no-brainer than this, because this they could lose 90% of their deposits. I heard management. I don't like their underlying business. I don't like the brokerage business. I do like the custody business and the business that they do with RIAs. They have a good moat. I think it's going to take some time to settle out. I mean, this business just had a heart attack. You probably don't need to buy it tomorrow. He paid some debt. He issued a lot more debt. This is probably okay. I'm not interested in it. I'd really rather own Bank of America here. This is not there. The thing about this one is it's not systemically important. Okay, so it's what you don't know that you don't know. I think it's just going to take a little time for this thing to work its way out. I mean, maybe in the low 40s, I'd have to give it a shot, start to build a position, but I don't have to do it. I have one that I'm taking advantage of the dislocation with something that's kind of a no-brainer. Whenever there's dislocation, I always go for the highest quality. Whether it's China, I go for Alibaba. Whether it was the banking in the pandemic lows and the energy, I go for Exxon, I go for Wells Fargo. In the commercial REITs, what could be hated more? Commercial REITs. What am I doing? Buying the highest quality buildings in the highest quality city in the entire world. I'm not buying SL Green because it's a little bit beaten down more, because SL Green has crappy properties relative to Vornado. So why am I going to mess around with Schwab when I could own Bank of America and Brian Moynihan? I mean, Schwab's a good business, but brokerage business over time, it's just, the RIA business is good. I don't love it. I mean, at $40, maybe I'd just take a little bit of a look, but I'm comfortable with what I have there. I think you're okay, Jason, but buy some at 45. If it goes to 30, buy more. I'm agnostic. No view on that. It'll probably work for you, but nothing there for me. Jason Reed, thanks so much for the wonderful content. I've learned so much over the last 1.5 years. One of the most important lessons I've learned is sticking with high confidence businesses and even adding to them in times of market dislocation. One of those positions, Alibaba, was wondering if you had any thoughts on the potential impact of the Restrict Act as it relates to Alibaba. Realize the current iteration will probably go through many modifications, but it gained traction in Congress. It's very broad, but would essentially give Congress the power to outlaw or ban any Chinese technology. Regardless, thanks so much for all you do, your hard work, willingness to provide such outstanding education. Jason Reed. Jason, they don't sell anything in the U.S. basically, so it's immaterial. This would more deal with Huawei and other types of technology, and to your point, it'll have other restrictions. All I care about is they're a toll taker in China. Their cloud business is going to triple over the next couple of years. They've got 50% share in the e-commerce. They got 38% share in cloud. They're going to break it up into 5 different parts. They've got the international, which barely touches the U.S., so this won't affect it in any way. Martin Crumlish. Tom, love the podcast and your overarching philosophical approach to investing. I'm investing actively for about 18 months now. My account's up big since following a value-heavy approach, looking for things that are dislocated with high margins of safety on the balance sheet, or at least minimal risk of insolvency if the business is a turnaround or needs time to turn to normal operating levels. Finding your podcast was refreshing. Finding your podcast was refreshing as your investing philosophy, similar to my innate view on the market, although far more sophisticated in your analysis. My AMA question is essentially how to screen for opportunities. Right now, I'm finding opportunities by scanning for low price to book and looking for things at or close to 52-week lows, and then going through the balance sheet business model to get a sense of how there is a turnaround or if they're simply too cheap purely based on the balance sheet as an initial screen before diving deeper into the business as a whole, listening to quarterly shareholder meetings. Also scanning, looking for PE, but not finding like I'm feeling I'm screening for things the right way to find meaningful things that warrant further research. Essentially, I'm finding that my screening process is not yielding the kinds of quality business I want to find. Just wondering if you share a few screening approaches. Thanks in advance, and for your podcast as a whole, and for all the work you do. Regards, Martin. So price to book is not a good metric. I would just leave that out. I don't really screen by any metric, because if you could do that, you could just leave it to the computers and they would do it. I look at basically all large cap stocks every day. So it's about, I don't know, a couple thousand stocks. I look at monthly and weekly charts, once every day or 2 days. And I look for trends. Like there'll be clusters of stocks that are down a lot, and then I try to figure out why and what's the bearish thesis and why they'll go down more or why they'll stop going down. And then, so it's top down, what's beaten down, why is it beaten down? Go up the food chain for high quality businesses, see the ones that compound capital versus the one that destroy shareholder capital over time, look for management, and then start the process. So there's no quick and easy way. It takes a lot of work, and it takes a lot of experience. But I think you're on the right track. I don't think price to book will work. And PEs, I don't look a lot at that multiples. You can look at price to free cash flow, but all those are starting points. You have to have a view. 12-month multiple is not really helpful for an investment because what you're looking for is a meaningful dislocation, so you have a margin of safety. And then what does normalized earnings look like 12, 24, 36 months out, and then what's the multiple on the basis of the normalized earnings? And oftentimes it could be single digits, and then you've got something worth doing some real work on moving forward. So, but I think you're on the right track with your gains and everything else. Just keep going. AJ Enos, your opinion on how the U.S. dollar's long-term outlook is affected by recent headlines stating Saudi, China, Russia creating a new currency to rival the U.S. dollar and using their own currency in oil trades. Headlines state these countries leaving the petrodollar system could end the U.S. dollar as the world's currency. It's complete nonsense. It's used by, mostly people trying to sell you books and bullshit. But U.S. dollar will always have hegemony in the world. It will lose power incrementally over time, but in the short term, I love the headlines because we need the dollar to go down for the emerging markets trade to work, and I think that will. And it will trend down just like it does every few years. I mean, I should have posted it. It was basically showing how the dollar, it runs in like 8-year trends, et cetera, and it's just starting its downtrend now, and that's going to be good for commodities and equities and that type of thing. But no, I wouldn't get caught up in that. That is a temporary setback. It's partially due to some administration errors as it relates to energy policy. But there's nowhere else to go. We have the rule of law. We have the defense. We have the reason you can never bet against America is because our DNA is spectacular. Effectively, what we have is the greatest risk takers from all of the nations around the world that have all assembled in one place, taking their talents, their ability to lose it all, taking a chance to come to America, start from scratch, build businesses, build a life. Some fail, some succeed. And you just don't have that anywhere else in the world, where you have basically the majority of people came from somewhere else, risked it all, and you'll never be able to replicate that. And we've got the best because 1 + 1 is 3 or 4 or 5 because we have every single culture in one place and the best of every single culture in one place. And it's an experiment that will never be rivaled. I mean, if you look at the Asian countries, they're mostly homogenous, whether it's Japan, when everyone thought Japan was going to take over the world, China, everyone thinks that China is going to take over the world. It's simply not going to happen because they don't have the magic formula that is America. And there's nothing more to say than that. And I think, boy, I wish I could have ended on that note, but we've got more. I think that is it. Well, in that note, we'll see. Oh, no, we do have one more. Okay. This from William Rooney. Tom, take a look at transcripts tweet on Goldman Sachs chart showing deposit rates lagging behind. I think this is a great representation of what you've been saying for weeks. Looking forward to today. I think that was more a comment. And then Nick Saltarelli, you're able to talk a little about why ASOS over Farfetch. Much higher quality business, much longer history. Like I said, the number one thing I need to see is how management has acted through cycles, and Farfetch has only been public for a couple of years, so there's nothing there. ASOS has been around for a long time. They made a couple mistakes. They're getting back on track, and that's one we're not going to speak a lot about. But it's had a nice bump, and now it'll back and fill and work its way higher. But overall, much higher quality business, much better management, and much clearer turnaround plan. So with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.